More about those movements now. We've got David Shapiro of Sasfin Securities on the line. A very good evening to you, David. And let's start with those overall market movements. I did say the JSE closing marginally in the green, but we saw a decent showing from your resources as well as your financials. I wonder if financials partly benefited from a rand that has gained some strength against the US dollar.
I think not only financials, but I think if you look across the board, a lot of the industrial and smaller industrials that don't push the index up, they haven't got enough weight to sway the index, also did very well. We saw some excellent movements there. I can't tell you what's behind it. The rand at 1770 is, I think it's almost a 4% to nearly 5% improvement from where it was on Friday, and that's great just ahead of the holiday season. But I think on our market, it's quite interesting to see the firmness that we are getting against a lot of conflicting or nervous news, which is not only the inflation, midterm elections, and a whole lot of worries about about China and their COVID policies. So lots for us to digest. But I mean, as long as the screen's green, do we really care?
Yes, we do care, David. And let's start with some of those things we care about. The Chinese government or health departments reiterating in a press conference that we will not be doing anything to get rid of our zero COVID policy at this stage. And it's all just a big rumor. No doubt it's going to be a volatile week for the markets in that regard. But also, like you say, in the United States, those midterm elections as well as inflation data also leaving markets a little volatile.
Yeah. While the Chinese government's saying that it's all rumor, the market's saying, no, it's not all rumor. And that's why if you look at Chinese stocks today, they continue their gains. They continue to move from the very low levels that we've seen, over the past few weeks. So we're seeing a huge turnaround in Chinese stocks, and it's giving an underpin to the market. There's still a bit of hesitancy on the commodity market. So there, people are a little more concerned. But to be fair, we haven't given back Friday's gains. We've given a little back, but not a lot back. And now, if you look as well, if you look at the oil markets very firm. And one of the reasons they're firm is that there's a view that with lockdown, Chinese demand will increase. So I think the markets are kind of not buying that. They're more believing that somewhere along the line, the Chinese are going to relent and, just make some concessions on their very harsh policies.
Yeah. And then just on the note of the United States inflation, what are you hearing in terms of what we're expected to see come out of the world's biggest economy when it comes to something that's put pressure on all of us, really?
Well, you have to watch the core inflation, and that excludes food and oil. Headline inflation is expected to be 7.9, which comes down quite a bit from the 8.2, I think, that we saw in September. But that's not good enough to sway the Fed. And I think even the core inflation will be down a little. So while the direction is right, I think it's the speed at which it's falling is not enough to sway the Fed. So I think we'll only see the big falls in a couple of months' time, well into the new year. So for the meantime, we're going to have to live with the grumpy Fed governor coming there and with his relentless policies of keeping rates high for longer. So, as a market person, this is not what we want to hear, but we understand,
We understand, but it is definitely not what we want to hear. David, redefine properties. I found this quite interesting. In a press conference, the CEO saying the reconstructive surgery of the business is basically complete. A whole lot of offloading of some assets which they no longer believe to be part of their portfolio that they want to grow. But overall, what did you make of the set of numbers that they put out today?
Look, I think you've got to give this time. There's still a lot of things dragging down the property market. Remember, as interest rates go up, so it makes their yields less attractive. They have to adjust for it. So, property trusts have always been a quasi-bond. And if rates are going to continue to rise here, it is going to affect it. And I think the other thing that we forget is that with load shedding, the costs of running buildings has escalated dramatically. So not only do you have inflation, but also to keep those, the generators going, the diesel costs and everything, I think can also weigh on their profits. So a nice result, always a well-run business. One of the leaders there, can't say anything about management, but I think just circumstances just holding down that sector.